Alan Lee's a CPA. Welcome back to the 6th installment of Tax Tip Tuesday. If you've missed any of the prior installments, check them out on our website at leesacpa.net. We're going to continue on our discussion from last week where we talked about LLCs and their formation and some of the requirements and guidelines you need to follow. We're going to take that one step further for an LLC that went out and wanted to make the S Corporation election. Unlike C corporations, where you have the corporation itself pay the tax, an S corporation doesn't pay tax typically. It's going to what they call flow through items of income and expense to the individual shareholders that on the form K1, proportionate to their percentage interest in the S corporation. S corporations do not pay tax in Texas. There is no state income tax. However, if you have an LLC or S corporation in the state of Texas, you're going to be subject to Texas franchise tax. Unless your taxable margin is over $1.13 million, you're really not going to owe any tax, but you're still going to be required to submit the annual filing, which typically for most CPAs, they'll file that electronically when they file your federal tax return. One of the big benefits of an S corporation over the DBA Schedule C is whereas with the Schedule C on your personal tax return, every dime of your net income is basically subject to two forms of taxation, and that's going to be the ordinary income component as well as self-employment tax. The S corporation removes a lot of that self-employment tax because you in essence are an employee of your S corporation or LLC, and you are going to pay yourself a salary. You're going to get a W-2. The W-2 you're going to have withholding, you're going to be paying in FICA and Medicare. Your company is going to match that, and that gets paid in periodically depending on your payroll schedule. Whereas with the sole proprietor DPA, in a profitable year, if you're not making at least estimated payments during the year, the likelihood is that you're going to get hit with a pretty significant tax bill at the end of the year. As an S corporation shareholder, you're required to pay yourself a salary. In essence, you're going to get a W-2, you're going to get compensation from your S corporation. That is an IRS requirement that you pay yourself reasonable compensation. Of course, no one knows what the term reasonable truly means, but in a grand sense of things, you have to look at it as a reasonable amount of compensation for the revenue and deductions that you are taking. If you compare that to the S Corp, to the Schedule C, you're not paying yourself a salary. The income itself is all subject to self-employment tax. Actually, what you do with the cash is your business. You're being taxed on revenue minus expenses. In a year that you have a loss, you basically do not have any earned income. The S corporation, on the other hand, that salary is going to help you earn Social Security credits, whereas a loss on the Schedule C, on your personal return as a sole proprietor, you're not building any Social Security credits. Another big benefit is a salary in the S corporation is going to allow you to fund a retirement plan, which is a win-win thing. You get to fund a retirement plan as an expense in your S corporation, reducing your taxable income that flows through to your personal return, whereas on the Schedule C, that pension expense or simple IRA or SEP IRA expense is not a deduction against self-employment income. Rather, it's an adjustment to income on the front of the 1040. As a result, you're able to really put more into a plan and expense it at the S corporation level than you could on the Schedule C, because it's not there on the Schedule C, but ultimately at a reduced amount on the front of the 1040 as an adjustment to your income. Now, a lot of other benefits, don't mind me if I look at my cheat sheet. I have a really nice graph that I have prepared for a lot of clients over the years that sort of compare the Schedule C to the S Corp, and every once in a while I like to go back and look at it myself. So, the losses on the S corporation are not going to be limited by a pension or a retirement plan. Whereas if you have a loss on your Schedule C, you're not going to be able to fund a retirement plan on your 1040, a deductible retirement plan, because you don't have any earned income. Another big advantage that we talked about with regards to the S corporation is, in essence, your salary is the only thing that is self-employment tax. Self-employment tax is nothing more than both sides of FICA and Medicare. As an employee, I'm an employee of my own PLLC, I get a salary. From my gross salary is pulled withholding tax and FICA and Medicare. My company matches the FICA and Medicare, and it's all paid into the IRS on a monthly basis. So I'm paying my tax obligation during the year. A self-employed person doesn't have anybody pulling anything from them. So if they're taking the money and spending it on boats and RVs and other things, they're going to be in a world of hurt before year end. They need to pull both sides of that FICA and Medicare, and that's all that estimated tax truly is. So on their tax return, on the 1040, the first page pretty much consists of nothing but the ordinary income that's being gathered, and then after the deductions against income, after the standard deduction or personal exemptions, which we'll talk about in another episode, you come to taxable income, your tax is calculated on the new tax rates, and then in addition, another tax for the self-employed, the self-employment tax is added to that. So you actually have two forms of taxation on the Form 1040 for a self-employed individual in a profitable year. In an S corporation, you're able to, depending on your shareholder ownership percentage, you're able to take a deduction for self-employed health insurance on the front of your 1040 against your ordinary income if you follow the rules correctly. If you have a loss on the Schedule C, then you are not able to take a self-employed health insurance deduction. Because you don't have any earned income, because you have a loss on the Schedule C, your health insurance deduction will not offset your income, but rather will be reported on Schedule A as an itemized deduction that is most likely going to be disallowed just because of the 7.5% adjustment, the limitation factor of medical expenses that seldom anybody that's healthy really get to take advantage of. There's a lot of little nuances with regards to S corporations that you just don't see with a sole proprietorship. However, there are a few disadvantages that I think we need to really discuss and point out there. Obviously, one of the most important being is that there's a lot more to accounting for your business. An S corporation typically will have a fully articulating set of financial statements embedded in the tax return. That's a balance sheet and a lot of profit and loss items. Whereas a Schedule C, you're basically reporting revenue and expenses. For an S corporation, that really comes into play and is very important for shareholders because you have to track not your equity accounts inside that S corporation or what they call your basis. The basis is going to only allow you to take losses up to what you have in the form of equity. If your equity is negative, you're going to wind up with some suspended losses. To take cash, a sole proprietor can do whatever they want with the cash. They're taxed on revenue minus expenses. In an S corporation, to be able to take a distribution, which is really nothing more than a return on previously taxed income, you have to have equity, and you also have to be taking reasonable compensation in the form of a salary. So there are some nuances that you might favor somebody with a small business that wants to stay Schedule C and pay the self-employment tax. But if you want to take the benefits of the S corporation, there are some certain rules that you have to follow. Obviously, the accounting work, tax preparation, professional fees are going to be a little bit higher, when you have an S corporation in play. But I think the benefits overall are tenfold. And if you need any more information on that, feel free to contact me, Alan Lees, CPA. Have a great day.